Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is Don Durrett, author of How to Invest in Gold and Silver, and also the recently upgraded and updated website, Gold Silver Data. Thanks for joining us here today, Don.
Thanks for having me, Jason.
Thanks, Don. We're glad to have you back, especially considering your experience and success in investing in the gold and silver sector. So before we start talking about gold and silver and the mining shares, which I'm sure our listeners definitely want to hear more about, let's talk about the general macro situation and where you see the world economy. And I know for basically a year now because, especially since early in 2012, you were writing in your email newsletter that you're expecting the stock markets to crash. So why do you think the stock markets haven't crashed then?
Have not crashed yet?
Yeah.
Well, there's a few reasons. The first reason is we've been somewhat stabilized since March of 2009. And as far as momentum goes, until you have a downward momentum, significantly when you break down the resistance levels, we've been able to kind of maintain the levels, if you will, between, say, the high and the low. We haven't broken down yet. And, of course, the money printing, the stimulating by the Federal Reserve and the ECB have definitely helped to stabilize the situation. For instance, in the U.S., we're currently not in recession technically, although I think we probably are. Europe is in recession, which is causing a lot of friction. It's causing a lot of tension, of course, with investors. So also we've had, since March of 2009, we've had relative growth, if you will, very small growth globally and in the U.S. And that's coming, usually, the business cycles, which we are in 2012, we're almost at 2013. So we're getting close to the end of that cycle, which kind of puts more pressure on this potential for a crash. I don't think that the economy is as strong as a lot of analysts have been saying. For example, on Bloomberg, you hear a lot of analysts saying that it's a good time to invest in, for instance, in the corporates, the high dividend yield companies, industrials, pharmaceuticals. I actually think it's a very risky investment at this time.
Well, Don, I think that's a very valid point here. The problem, though, Don, is that people still need to get a return somehow, some way. And you have these fund managers, and they all need to chase certain benchmarks for a certain return. And especially with pension funds like CalPERS, where they've only been able to get, a 1% return now every year for the last few years. And in their mandate, they were basically that they were going to be able to get, and in their models too, a 7% return. So I think that's why you have a lot of these guys going on, CNBC, Bloomberg, et cetera, and talking their book. I think you brought up also a valid point here about why the markets have not crashed, is that there is all this money propping things up, because I listened to some interviews from Charles Biederman of TrimTabs, and Charles focuses a lot on flow of funds going in and out of markets, and from what he was saying, almost all the retail money is leaving the stock market and it's going into bond funds. So the question is then, how are stocks being propped up then if all the retail money is leaving and going into bonds?
Yeah, that's a tough question to answer. To know why it's being propped up on the stock level, why people are investing. I think part of it has to do with your 401k money. Every month you have 401k money flowing in, and they're putting money to work. Some of the fear, you don't have a lot of fear right now, significant fear that the stock market is really going to break down. So we are having money into the stock market. But let's look at some of the factors, the risk factors that I think a lot of people are ignoring. I mean, a lot of the analysts out there are seeing these risk factors, and they're significant, and it's across the board. A lot of the analysts think that this is just the same old business cycle, that America is this very strong, vibrant economy, strongest economy in the world, and we're just coming out of this business cycle and we're getting ready to grow again. I've heard some people say it was a new bull market for stocks. Well, it's fascinating to me how people can ignore if you do a lot of work, a lot of analysis, and for me, I'm investing in gold stocks, mining stocks, which I think are probably one of the higher risk. And the one thing that's going to hurt the mining stocks is the price of gold. And there's really only one thing that's going to hurt the price of gold, and that's going to be a strong economy. So I have to do a lot of analysis, a lot of macro analysis if I'm going to invest in gold. And right now, the mining shares are down significantly. The HUI is down from almost 650 high in the last 12 months. It's right around 400 right now, so it's down 30% plus. So those mining shares have been hammered. So why am I still in the mining stocks? Well, if we start looking at all of these factors, I mean, we can talk about a lot of them, but it is incredible how many are at play here. For instance, if we look at national debt, 1980, our national debt was less than $1 trillion. Today, it's approaching $16 trillion. We're adding $100 billion a month. The interest rates are literally manipulated in order to pay that debt, to pay the service on that debt. If our 30-year interest rates were, say, 4.5%, and our 5 years were, say, 5%, we couldn't even pay our interest, or it would be very difficult to pay it. So if interest rates go up just a little bit, we're in serious problems. Then you have household debt. In 1980, household debt was 50% of GDP. Today, it's 100%, and families are literally living month to month. And the saving rates are practically nil. Then you look at corporate debt. Corporate debt in 1980 was only 12% of GDP. Today, it's 100%. They say that the balance sheets are strong, $2 trillion in cash, but the overall debt levels are much, much higher than historic. Plus, you have a lot of the corporate debt is off balance sheet, what we call these level 3 assets, especially in the financial system. And these are just 3 issues. I mean, we can talk about more of them. And so you have this significant risk in the economy that didn't exist, say, 10, 20 years ago.
I think you've brought up some very, very valid points here, Don. And I think you've definitely touched on the point that there's a big divergence between the real economy, which I don't see any improvement in, and even these fake statistics that Wall Street brings up, like you said earlier in the interview, about that we're not going into recession, and those are doctored statistics of pretty much all of them. And then the divergence there where the market is still going up. So what I think is happening is the Fed is printing a lot of money, or other central banks are printing a lot of money, and foreign capital that was sitting on the sidelines that doesn't want to be in cash is either going into our market because they view that as safer compared to other stock markets, or it's the money that like I said, that the Fed prints up and hands to banks and tells them to prop up the stock market to protect their tax revenues.
Right. Well, let's just look at the debt level. I think that our economy, the U.S. economy, and the Western economies, Europe, and you can even include Japan and China, I think that all of those economies right now have a growth problem. And when you combine a growth problem with a debt problem, that increases the risk significantly. It creates a lot of risk on to be able to service these debts. It creates a lot of risk on the ability of companies to grow. And so growth, I mean, our whole economy is based on growth. I mean, if you look at, did they hit their number? I mean, every day you turn on Bloomberg and they say, okay, did they hit their number or not? Top line growth, bottom line growth. Well, if you can't grow and you cannot service your debt, then things are going to start. It's inevitable that you have some type of you coalesce. You basically have to retrench back to a certain baseline, if you will, and then start growing from there. Well, what is that baseline going to be? Where are we headed? Where are we headed? And we can talk about the reasons why we have a growth problem. But what is? It amazes me. I heard Howard Kunstler say that people are just insane today. The things that are coming out of people's mouths, because they're not looking at the holistically, looking at the whole environment, the whole situation. If you look at, for example, the debt levels, mathematically, the United States cannot pay down its debt. Europe cannot pay off its debt. So what are our options here? Well, we can print, but if you do that and you do not have growth, eventually you have bankruptcy. Eventually you have insolvency. And so the insolvency is coming. So we are in a countdown to insolvency. let's bring in the derivatives. In 1998, we had only 10 trillion. 10 trillion, that's a lot of money, but we only had $10 trillion in derivatives. This is when Brooks Lee Born was she made her attempt to regulate derivatives, and she failed. So derivatives are not regulated. Now derivatives are over $500 trillion. Well, those derivatives are all interrelated. I mean, the majority, well over 50% of the derivatives are in 4 United States banks, our 4 largest banks. So all it would take is problems in one area of the derivatives to kind of infect each other and have a derivative meltdown. So that's just one area. Then if you look at the U.S. dollar, currently the U.S. dollar is being held everywhere around the world because of everybody wants to have our bonds because they think it's safe. That's why you have a 10-year bond at 1.5%. So everybody wants to hold these dollars. Well, what happens when people don't want to hold their dollars? Well, you have a meltdown. You have a potential there. You have a potential for the U.S. dollar collapse. So you have all of these macro potential problems. They just keep festering. They keep getting bigger and bigger and bigger.
But yet all these reality TV shows and the news, I mean, they don't even talk about these issues that much.
No, right, right.
If you don't watch CNBC or Bloomberg, I don't think these issues are talked about for more than a minute or 2 minutes a night. And then they're spun, so there's a positive outlining.
Yes, exactly. One of the biggest ones is peak oil. Peak oil is completely spun by the mass media, mainstream media. Everybody says that peak oil is a non-issue. Well, anybody that does a lot of analysis in the peak oil area, for instance, oil production has not grown since 2005, and here we are in 2012. We've been on a plateau for 7 straight years. And in tandem with that 7 straight year plateau, exports, and this is the number that people need to see and need to recognize. You need to look at a chart of exports from the year 2000 to the year 2020. So, of course, from 2012 to 2020 would be, projected exports. But from 2000 to 2005, exports increased. And in 2005, we peaked, exports, of course. And exports have decreased. And these are global exports. They've decreased from 2005 to 2012. So our exports are decreasing, and those exports will never get back to the 2005 level. So how can you have a growing economy if global oil exports are not going to ever increase again? So we have this energy crisis that's looming, and everybody just laughs at peak oil. Well, the reason why they're laughing at it is because they don't want to. Most people do not want to acknowledge the potential, because oil, there's so much energy in oil. You don't get that kind of energy, for example, in ethanol or for wind energy or solar energy. It just doesn't pack the punch that oil does. So when oil is shrinking, you have a problem, for example, your BTU level. Of course, in the United States, we can use coal, but they don't have that option in a lot of places around the world.
Those are some good points, Don, and if I could add a little bit on the peak oil thing, I would just add that it's the end of cheap and easy oil because, like you mentioned, the conventional oil production did peak around 2005. Now, we have quite a bit of unconventional oil left in shale plays, deepwater offshore, oil sands, etc., but all of that stuff is very, very expensive to produce, and the energy return on energy invested is fairly low.
I'm glad you brought that up. The reason why we have a growth problem is because we no longer have cheap energy. If oil today was $30 a barrel, we would probably have 3% growth in this country, and we'd probably have 10% growth in China. We don't have $30 oil. Oil is the energy. It's literally the lifeblood of the economy. So we don't have cheap energy anymore. That's creating a growth problem. So how long can we keep oil at $100? Now, I think it's possible we could see oil in the low 80s if we have a big drop down in global growth, but it's just a matter of time before it pops back to 100. Now, at what point can you no longer have global growth? This is something that people don't talk about or acknowledge, and this is the reason why I invest in gold, because without oil, you don't have growth. Without growth, you have problems. The debt problem becomes a huge issue. You start having a meltdown. The price of gold is inevitably going to go up. Now, in this conversation, I'm hoping we can talk about I have 10 reasons why to own gold, and I have one reason why not to own gold. But I go back to this price, the reason why we have a growth problem. We have a growth problem because you don't have cheap energy. So at what point does the global economy stop, growth literally stop? I think it's somewhere between 120 and 150 on oil. So how much longer is it going to take before we hit those numbers? My feeling is it's going to be somewhere around 2015, which isn't that far away. Now, I originally did my projections back in 2006 when I did my first analysis on peak oil. I projected that the energy crisis would hit in 2012. Now, I probably would have been right, but we had the crisis in 2008, and energy use in the United States dropped by 3 million barrels a day. We were up to almost 20 million in 2005, 6, 7. We all peaked about 20 million barrels per day. Now we're down to 18. So the U.S. usage of oil has dropped 3 million barrels. And if U.S. has dropped, of course, Europe has dropped. So all of that is the reason why we haven't had a shortage and we haven't had an energy crisis. But around 2015, we will have an energy crisis, and people are saying, "Oh, we're fine for the next 20 years," and it's dreamland. It's not going to happen. And when this energy crisis hits, the U.S. at that time the United States will have $20 trillion in debt around 2015. We're going to have a huge problem, and we can talk about the fallout of that.
If I could add a few more points here before we transition to talking about gold and silver on the energy topic, I would say that for oil demand, yes, you mentioned the developed countries like the U.S., Europe, Japan. Demand there is going down, but the demand in developing countries in the G20 has more than offset that, and those people want to consume more, and in a lot of cases their oil is subsidized at the pump. So I think that's going to put a demand driver on the oil price, and I think that's going to put a price floor in the oil along with the higher production costs for this unconventional, higher production cost marginal oil. In terms of other topics I would like to discuss here, I think we should probably move on to gold and silver now.
Sure.
Gold, for the last 12, 18 months.
Before we go on to gold, well, I guess this is kind of the global macro. I wanted to talk about the why own gold, and why not too. Before we could talk about that. You wanted to finish your question first, or
sure. Well, I was just going to ask you that. Why do you think gold and silver have been consolidating for so long here? Because it seems to me that gold's in about $100 an ounce trading range, from about the low 1500s to about the low 1600s, and silver's in about a $2 an ounce trading range.
Oh yeah, yeah. It basically coincides with investor mentality right now, where you have the stock market is also in a trading range, so they're kind of going hand in hand. As a matter of fact, gold is being perceived as a risk-on trade right now. So since it's on a risk-on trade, it's kind of following the stock market, if you will. There isn't a disconnect. And so that's the reason why you have this. It's in tight, narrow range. And of course, I've been following it very closely. I've been waiting for when it's going to break out. And I think that 1640 is a significant number. I think that if gold closes over 1640, that the low might be in. A lot of people say the low's in right now. I don't think so. I still think there's a possibility that we could have a severe market correction in the stock market sometime between now and, say, November. And if that happens, you could see a gold go down to the low 1400s. So we haven't broken out, but we're getting very close. We've had this incredible correction, especially in the stocks in September. So once it breaks out, it will break out. We haven't had a decoupling yet. When I talk about a decoupling, I say the gold goes up and the stock market goes down, and people go. There's a flip, and the flip is a security trade. So you have the security being that you want to have gold for safety. So people right now are not investing in gold for safety. On the whole, they're investing for gold as an investment. It's a momentum trade, if you will. It's a risk-on trade instead of a risk-off. So when we have this flip, we have this decoupling, that is the big flip, and that's when you're going to see this change from this narrow trading range, and you're going to see silver jump over 40. You're going to see gold jump over 17, 1800 in the next 12 months.
Yeah, but before the corrections, there was a lot of leveraged money, like all these hot money momentum hedge funds and high-frequency traders that were all long paper gold, I guess you could say, paper gold and paper silver, and that were in the mining shares. And that flow of funds is just basically gone. It's completely evaporated out of those markets.
Right.
So I was actually very surprised, and I think it's good for the relative strength of gold and silver that, you know, the Fed came out a couple days ago and they didn't announce the next stimulus program right away, and then gold only dropped, what, $10 an ounce, and then it's right back up again today. So normally in the past, gold wouldn't have done that. The last couple years, normally if the Fed would not have given, you know, the stimulus or easing that the market wanted, gold might have dropped $70, $80 an ounce in 24 hours.
Right. That's a sign that the flip is near. What I call the flip is from the risk off to the risk on to the risk off, where gold is considered a risk off trade. So you can tell that the flip is near. But the only thing that's going to push gold down right now is a big drop in the stock market in the near term. But the only thing that's going to push gold down and keep it down is growth. So I want to go over these 10 things since I wrote them down. So the only thing, again, the only reason not to hold gold is if the global economy begins to grow and debt becomes manageable. If that's the case, then you don't want gold. And that's the risk in owning gold, because if debt becomes manageable, if the U.S. economy starts growing at 2.5% and we start adding 200,000 jobs a month, you're going to see gold go down to $1,300, $1,200. But it's going to have to be a sustainable growth, of course. But I don't think it's going to happen. But that's the only.
I don't think that's going to happen either.
Right.
I think you put out the mathematics of the debt. There's negative compounding here,
right.
And not only can we barely pay the interest payments on the debt, we have no hope of paying the growing principal on the debt.
Right. But that's the that's the only thing I see that can drive gold down and keep it down. So, but look at the 10 factors, the reason why to own gold. So the first one is the bond market. So the global bond market is about $50 trillion. That bond market is dependent on being able to service that debt on those bonds. The people that have the bonds, they have to pay those bonds back. So it's a debt market. So when we're talking about the bond market, we're talking about government bond, we're talking about corporate bonds, but all of that bond has to be paid back. So if you have just 1% of people pulling out of the bond market and saying bonds are no longer the safety, that gold's the safety, then it's not going to take very much bond money that flows into gold to push the price of gold up. I really think we're going to see a $100 up day in gold in the next 12 months. And it's going to come directly from the bond market. So that's number one. Number two is the fear trade. So right now you don't have a lot of fear out there, especially in U.S. You do have fear, but it's not the kind of fear that I think can really drive the price of gold up significantly. Then you have central governments buying up gold, physical gold, which is new. This has only happened in the last 3 years, and it's increasing. So they're buying up the physical. China, it's amazing how much physical gold that they are buying up. So that's squeezing the physical market. Then you have number 4 is the momentum trade. The momentum trade is dead right now in gold because, like you said, all that money's pulled out. But once we see gold go to 1,700, 1,750, the momentum trade will be back on. And the momentum trade can push gold, who knows? I think it's going to push it all the way to 3,000 in the next 24 months. Then you have number 5 is the security trade. That's what I call the flip, where right now it's risk off, it's risk on, but I think it's going to flip the risk off, which is a potential. Number 6 is supply constraints. And this has something. We only mine 2,500 tons a year, so gold has limited supply on how much is available. Number 7 is you only have ownership. Only about 1% of the U.S. population owns gold. 1% of Europe owns gold. So nobody owns gold. How can we be a bubble if nobody owns it? Number 8, it's really resistant to inflation. It's a hard asset. People are going to want to have hard assets. Number 9, markets are being manipulated today. If markets are manipulated, basically, I think free markets are dead. I don't think they're coming back. And so that's not positive for the economy to grow. When you have all this manipulation, how can you get growth? And number 10 is politics. our political system is fragmented. We fragmented. The conservatives and the Republicans have split apart. They do not talk to each other. They do not agree on anything. So how are we going to have any solutions in the economy? So those are my 10 reasons why to own gold. So I wanted to do those today.
Well, I'm sure listeners are going to appreciate that a lot, Don. And you brought up one of the points in there, and I think it's very important here, is that central banks are dollar cost averaging into physical gold positions here, and the retail investor, especially in the United States, if you look at the stories coming out, is stop buying physical gold and silver. That because of the price correction, I would basically call this a contrarian indicator. And because sentiment is just so negative, this is part of the bottoming process. So would you say that this is very healthy for the fact that we're going to be very close to a bottom here is because the retail investor has started throwing in the towel? Because, we're getting some hate mails and emails and Facebook messages and nasty texts from consulting clients talking about gold and silver are never going to go up, blah, 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 blah. I should not have bought any mining stocks, blah, blah,
right.
blah.
Yeah. I have to think this was very healthy correction for gold. It actually has allowed, and it's occurring right now as I speak, it's allowing people to buy stocks very cheap, very, very cheap, a lot of these mining stocks. So you'll be able to dollar cost average and buy and get in a lot cheaper than you were. We're almost back to 2008 levels on a lot of these stocks. For instance, Silver Standard, it's all the way down under $12. We have a potential. We could see Silver Standard. We have a huge drop down back to maybe $7, $8, $9 if we have a big correction in the stock market, back to 2007, 8 levels, 2008, excuse me. So that's
a massive short squeeze right there too, because they haven't hit any of their production and guidance targets, and they've missed revenues and earnings for a long time. They've had production problems at Perquitas, so that's a potential short squeeze there if they can get that mine turnaround.
Right. Well, long term, I think it's a $100 stock. So you're buying it at $10. It's a potential 10-bagger because they have just so many reserves. 1 billion ounces of silver. Their production over the next 5 years is going to increase. So, that's just one mine. There's lots of them out there. A lot of the majors. I just think that we're getting ready to flip a switch here on the majors. All it's going to take is the price of gold to go over 1,700, and these stocks are going to start rolling. Then once we get to 1,800, they're just going to roll more, and the upside is very significant. Also, I think the price of oil is going to be controlled for the next 2-3 years, so that you're not going to have this huge cost increase for the miners. It's going to kick in after 2015, of course, but you might be able to get out of your mining stocks by then. But I think it's healthy, this big correction, and I think that we're getting ready. It's getting ready to take off. Now, it might not happen in 2-3 months, of course, but I expect it sometime before the end of the year. I think gold prices will end the year over $1,700, but we'll see what happens going forward. There's a lot of risk, of course, because I said there's some downside. We could see low 1400s in gold, and it's hard to say what's going to happen here. But we do know that long term, people are going to run to gold. So it's a long term. When I say long term, I'm talking 3 to 5 year horizon. That's what I invest in. So long term, gold is a great time to get in. It's a fantastic time, entry point. SIL, for instance, which is a silver mining ETF, which has about 30 silver mining stocks, is incredibly cheap. GDXJ, and it basically has all the silver miners, all the producers in it. And then GDXJ, which is a mid-tier ETF. Incredible entry price right now. So good time to get in.
Okay, well, let's dive down a little bit deeper into the mining sector here, Don. And your analysis, you tend to favor, since you have that 3 to 5 year target, you're looking towards that mania stage, that blow off top stage, and you tend to favor the juniors, which are proving up a deposit or are constructing mine, instead of the more established producers. So talk to our listeners about why you prefer those types of stocks over, cash flow producers. And then maybe talk about the valuations compared to what the market is assigning on the multiple right now for the juniors compared to some of the producers.
Sure. Well, first of all, I don't favor the juniors. I just invest in them. I use what's called a pyramid approach. And I write about that in my book, How to Invest in Gold and Silver. I believe that you should have a foundation of bullion, and 15% of my portfolio is in silver bullion. And then I also believe that you should also have majors down there on the bottom of the. And I actually have 35% of my investments in majors in gold mutual funds. So full 50%, I have the base. And then once I have my base, then I work up. Then I do the mid-tiers and I do the juniors. But I focus a lot on those juniors because I think that that's where you're going to make your big money. So in my book, I have 70 pages on the junior chapter, and I explain how to analyze them. And then on my webpage, goldsilverdata.com, there's actually chapter 11, and chapter 10 is on my website. And you can read that chapter. It'll help you to understand how to analyze a junior if you want to get into it. I also have some YouTube videos. But the juniors, the upside potential is amazing on the juniors. Yes, there's a lot of risk. You have to diversify. I don't think that you can do 5 juniors and have the kind of returns you want. I think you have to do at least, say, 20 juniors or 30 juniors. You have to diversify because there's just so much risk. And a lot of these juniors are going to get taken over, and when they get taken over, you're only going to get a 50% return, 100% at the most on a lot of these takeovers. So that's a lot of risk, and a lot of them are going to get taken out, of course. So I think you need to get about 30 juniors. You've got to do a lot of analysis. The upside is amazing. I mean, I think in my book, I say that I want to average a 500% return in gold and silver mining stocks, and I think I'm going to. Maybe 400%. It depends what kind of mania blow-off we have. And the reason why I'm going to have that kind of return is because I got 50% of my money in juniors. Now, a lot of people would say that's very risky, and I agree it is. But I think it's going to pay off because I think that the odds of gold hitting $3,000 an ounce are very high. So if you're buying them today, they are very dirt cheap. You can do the analysis, and you can find companies where you can buy a future cash flow multiple under 1, and they have potential to increase that to the future where you could actually sell it at potentially 5 or 10. The upside potential is amazing on a lot of these juniors.
Yeah, for some of the gold juniors, the gold's in the ground for measured and indicated resource at $50 an ounce of gold or less. I think La Mancha sold for about $50 an ounce of gold. And then for some of the silver juniors, you can get silver in the ground for measured and indicated, I think, at $1 an ounce or less.
Right. I have a database, and I've analyzed 500 companies over the past year. And on goldsilverdata.com, you can go to the companies page, and there's 500 companies in there, and you can see all the information that I've analyzed them. And that's free. And then you can actually have a search database where you have to be a member, which is $100 a year, and you can actually compare. And if you can look and find whatever kind of companies you want, you can actually do a lookup and say, show me all the silver companies that have silver in the ground under $1. It'll show you, or all the gold companies under $50. And it'll show you. It'll give you a list of all the potential companies out there, and you can analyze them. You can spend hours and hours and hours analyzing and finding potential companies to invest in, and all the data is right there for you. I've done that for you through hundreds and hundreds of hours of research to create this database. But you're right. I try to find companies that have gold in the ground under 50. That's what I call a low valuation. And then I look at the future market cap growth rate to see what it is, and I want a future market cap growth rate over 500%. And I have the market cap growth rates right there in the database. You can query. Show me every company that has a future market cap growth rate over 500%, and it'll show you right there. Boom.
Very good. And I think the reason I mentioned that you were more favoring of juniors is because in your rating system, you tend to rate the juniors that are not cash flowing and producing higher than the producers.
Right.
So
right.
That's something that might be a little confusing for people who are not familiar with your system.
Right. Yeah, I use a rating system that I devised, and most of the majors are rated very low, 1.5, because they're just so large. It's going to be hard for them to grow. So I actually think that you shouldn't invest in an individual major. You should invest in mutual funds or ETFs to reduce your risk. But you should own some for diversifying risk. But yeah, and then once you go to the junior level, I try to find companies that are rated 3 or higher. A 3 is a potential 5-backer or a potential 500% return. So and right now I'm focusing on, because we have had this incredible correction, I'm focusing on companies that are 10-baggers. potential 10 baggers. Those are the only stocks I'm investing in right now because of the correction. You won't have that opportunity. I don't think in 2 years you just won't have it. You'll have to focus on companies that are potential 5 baggers.
Okay, well, I have one final question here, and a lot of it has to do with the how the TSX Venture has just gotten creamed. Now, all mining stocks have gotten destroyed, but the juniors have just gotten clobbered even worse because, there's no production, there's no cash flow. A lot of these companies are, according to analyst John Kaiser, who covers the venture exclusively, are below 25 cents a share. They have less than 6 months of working capital left. The commodity prices, well, gold and silver are close to breaking out. They haven't broken out yet. So what percentage of those juniors, then, do you expect to either sell out their assets for pennies on the dollar like an Extori Gold type of situation where, you don't get a premium, where management just gives up and you might break even if you were lucky? And what percentage do you maybe expect to go bankrupt then?
Right.
Not be able to raise any money in this environment or dilute their shareholders, to no return whatsoever,
right.
Before that next big up move in the mining cycle and the commodity price.
Right. This is the reason why investing in gold and silver mining stocks is so difficult and has such high risk. You have about 1,500 juniors, and there's only about 300 solid juniors. And then you only have about 70 producers. So you have 70 producers, and you have over 1,000 companies that are juniors that have no cash flow. So these companies that don't have cash flow, the risk is tremendous, especially today when you have the financial situation we have. These companies are going out and they're trying to raise money, and they have to raise money generally every year. They have to go back and raise money from investors to continue their drilling programs or exploration programs. So the potential for these companies to go broke is very, very high. That's why you have to do your research. You have to know the kind of risk that you're taking, and you have to be careful. And so if you look at the projects, you have to look at all the data points. There's lots of them. I mean, we could spend 2 hours just talking about how to invest in a gold mining company, all the data points to look at. I have a 1-hour YouTube video that goes over, and I didn't, how long are people going to spend, on YouTube videos? You can only do so much. But yes, I think that a lot of these companies that have these good projects are going to be forced to have these mergers and be forced to merge with these companies for pennies on the dollar. So it's a tough time. That's one of the reasons why people are staying away from the juniors, because just about all the juniors do not have cash flow. Like I said, there's only about 70 producers out there. So just about all the juniors don't have cash flow. People are staying away from them, even though they have fantastic projects. I mean, Spanish Mountain, for example, is just one. I mean, fantastic project they're moving into production, and it's just priced incredibly cheaply. I mean, nobody wants it. It amazes me. But I think the odds are that about at least 25% of these companies that have really solid projects will be able to get them into production. But I'm just throwing some numbers out there. Maybe 75% of these companies will either go broke or get taken over, the ones that have the good projects. Because if they have a good project, they become, bullseye. Everybody's going to want them. For example, Jaguar Gold right now, their stock has dropped 95% from its high. It's down 90% for the year. It is so cheap. It's just begging for somebody to go in there and buy it for a discount. I mean, they have the potential to have 400,000 ounces of production, plus they have a huge property down in South America, in Brazil. And there's companies like that. They're just bullseyes.
And 8 months ago, there was a $9.50 per share all-cash offer from a Chinese firm.
Yeah.
So, I mean, on a proven and probable gold reserve basis using a low gold price, I mean, I talked to friends in the business, another mining analyst, and he thought the stock was valued over $60 a share. So,
yeah.
Yeah. So, I just don't expect these valuations to stay this way for a while. I mean, someone, maybe a Yamana or larger players, going to come in and make an offer
We're
at some point.
We're going to have huge consolidation. What's going on right now is ugly, in my opinion. You had Hecla Mining make a 25% premium offer for U.S. silver. 25%, unbelievable. They basically said, okay, we want to buy you at a discount because U.S. silver share has dropped 50%. It's dropped 50%, and they only offered them a 25% premium. Jaguar Mining is selling for less than $10 an ounce of gold in the ground, and they're a producer. It's unbelievable. They should be selling at $150.
That's another short squeeze, yeah.
Yeah, it's crazy what's going on right now in the mining stocks. But once we get to $1,700 gold, you're going to see the majors lead the way. They're going to start having profits. People are going to, Yamana's going to jump from 43 to 70 really quick. And everybody's going to follow, and then the juniors are going to get involved. But again, only about 25% of these juniors are really going to play or are going to give you these huge returns. So it's a tough game, real tough game.
Well, I think you've done a really good job, Don, doing some advertising for your new website and your subscription service. So can you tell our listeners if there's like a free trial, and tell them more about your books and your website and where they could find you those before we let you go?
Well, thank you. Thanks for letting me do that. First of all, the website, goldsilverdata.com, that just went live 2 weeks ago. And there's 500 companies in the database. You can be a member for $100, and you can search all the companies. And you'll see, for free, you'll be able to look at all the data in the company's website. You just won't be able to compare companies or do searches. But for free, I give you my database. You can go into the companies. You can look at any company you've invested in, any company you've thought of, and all the data is available. It's all right there. Now, a free trial, we're going to have a 30-day free trial coming up. It's not quite available yet. In the next couple of months, there will be a 30-day free trial, so you'll be able to go on and do the search engine and see how all that works. Also, the book. The third release of the book is going to be out any day now on Amazon. I'm waiting for it to come out. It's going to be the third edition, and it's 270 pages long. Anybody that wants to learn how to invest in mining shares, stocks, there's nothing else on the market that will teach you like my book. So thanks, Jason.
And I would agree with that for our listeners, because Don has been in this sector making money successfully for a long time. How many years is it, Don?
Well, I started in 1991, believe it or not. I go all the way back. That's when I started in mutual funds. But actually, the junior mining shares, I started in 2004.
Okay. So that's longer than a lot of other people in this business that have been claiming to be experts. So Don does a really good job. I've been on his newsletter and sending a lot of emails back and forth, and Don does a great job for our listeners out there of taking the very, very complicated and explaining it in much easier to understand terms. And unfortunately, a lot of other people in the industry, some of the hardcore geologists, don't do a very good job of this. Mm-hmm. So I think Don is a really good bridge for the layman and for the geologists here to help out our listeners to outperform some of those indices instead of like the GDXJ or the SIL.
Yeah. One final point when closing. I actually wrote the book because when I started investing, I couldn't find one. And I'm actually a writer. So since I'm a writer, I said, what the heck, I'll write one. I'll write it since nobody else has written it. So I wrote the book to help people to understand how to invest in mining stocks.
And that's a free market solution to problems. That's what I like to see. Don is a writing entrepreneur. So thank you again, Don, for the interview today, and hopefully we'll have you back on soon.
Thanks, Jason.
When gold, silver are higher.
All right. Appreciate it.